Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about OPENDOOR Technologies Inc. annual report. OPENDOOR Technologies Inc. offers a range of services for residential real estate transactions in the United States. The company's primary business involves buying and selling homes through its digital platform. It provides three main products: Sell to OPENDOOR, which allows homeowners to sell their home directly to the company; List with OPENDOOR, which enables customers to list their home on the MLS and receive a cash offer; and OPENDOOR Marketplace, which connects home sellers with institutional or retail buyers. In addition to these products, OPENDOOR Technologies Inc. also offers various services, including real estate brokerage, title insurance and settlement, escrow services, property and casualty insurance, real estate licenses, and construction services. These offerings enable the company to provide a comprehensive solution for homeowners and homebuyers, streamlining the residential real estate transaction process. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to skyrocket. The stock price of OPENDOOR Technologies Inc. has seen a significant surge in the past year, leaving investors and analysts eager to understand the underlying factors driving this trend. One possible reason for this increase is the company's innovative approach to the real estate market. By leveraging technology and data analytics, OPENDOOR has disrupted traditional brick-and-mortar models, making it easier and more efficient for buyers and sellers to interact. Another factor contributing to the stock price growth may be the growing demand for online real estate platforms. As more people turn to digital channels for their housing needs, companies like OPENDOOR are well-positioned to capitalize on this trend. Additionally, the company's focus on providing a seamless and user-friendly experience has likely contributed to its success. Furthermore, OPENDOOR's expansion into new markets and its strategic partnerships with other industry players may also be contributing factors. By expanding its reach and building relationships with key stakeholders, the company is able to tap into new revenue streams and increase its market share. In conclusion, the stock price of OPENDOOR Technologies Inc. has skyrocketed in the past year due to a combination of innovative business models, growing demand for online real estate platforms, strategic expansion, and partnerships. As the company continues to evolve and adapt to changing market conditions, it is likely that its stock price will remain strong. OPENDOOR Technologies Inc. market capitalization of $5 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that OPENDOOR Technologies Inc. holds a significant advantage in their industry. OPENDOOR Technologies Inc. trades at a higher price-to-book ratio of 4.61 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, strong brand recognition and increasing market share due to improved product and customer experience are significant contributors. Additionally, algorithmically generated offers within minutes have increased conversion rates, while data-driven home assessments have improved accuracy over time. Optimization and enhancements of pricing engines, platform efficiency improvements through generative AI, automation, and self-service, incremental attach of services, continuation of agent-led distribution channels, and leveraging the platform to develop additional offerings have also driven revenue growth. On the decline side, failure to expeditiously sell inventory, declines in real estate values, oversupply of home inventory, leading to downward pressure on sales prices and margins. Disruptions in supply chain for materials and labor constraints, regulations impeding ability to sell inventory, volatility in home prices affecting inventory value and sales pace, loss of key personnel. Local and regional economic downturns, changes in zoning laws, labor costs, property taxes, and operating expenses have all contributed to revenue decline. Seasonality and timing of property acquisitions and resales also play a role in fluctuations in revenue. The net income of the company experienced a significant decline between 2023 and 2025, with losses increasing by 232%. In 2023, the net loss was $275 million, which rose to $392 million in 2024, and further to $1.3 billion in 2025. This substantial increase in net loss can be attributed to the constrained U.S. housing market due to elevated mortgage rates and affordability challenges. The profit margins also underwent a change during this period. The gross margin decreased from 7% in 2023 to 8.4% in 2024, but then dropped back down to 8% in 2025. On the other hand, the contribution margin showed an improvement from -3.7% in 2023 to 4.7% in 2024, only to decrease to 3.4% in 2025. The decline in net income and profit margins can be directly linked to the struggling U.S. housing market, which has resulted in decreased existing home sales and constrained inventory levels. The company's operating cash flow has been inconsistent over the years. While there have been instances of positive operating cash flow, such as $1,049 million in 2025 and $2,344 million in 2023, there have also been periods where the company experienced negative operating cash flow. In fact, the net cash used in operating activities was -$23, -$13, and -$9 in 2024, 2023, and 2025 respectively. This inconsistency suggests that the company's ability to generate positive operating cash flow is not reliable. The company's debt level has undergone significant changes over the past few years. Initially, the total outstanding balances on asset-backed debt remained at $1.1 billion as of December 31, 2025, with no change from the previous year. However, a closer look reveals that this figure is an increase from an unknown previous year. Furthermore, the total liabilities related to variable interest entities, VIEs, decreased by $815 million in 2025 compared to 2024. Additionally, the non-recourse asset-backed debt increased from $1.924 billion in 2024 to an unknown figure in 2025. In contrast, the interest expenses have shown a significant decrease over the years. The interest expense decreased from -$211 million in 2023 to -$133 million in 2024, and further to -$131 million in 2025. This represents a substantial reduction of $80 million in just 2 years. Moreover, the loss on extinguishment of debt has also increased significantly, reaching -$924 million in 2025 compared to a gain of $2 million in 2024, and a loss of -$216 million in 2023. Overall, while the company's debt level remains high, the interest expenses have decreased substantially over the past few years. However, the increase in loss on extinguishment of debt is a cause for concern. Management's primary focus is on achieving future financial and business goals through a comprehensive strategy. Key objectives include growing market share, expanding the business through new products and technology rollout, and leveraging AI for operational efficiency. The company aims to enable digital transactions with fewer intermediaries, expand its platform nationwide, and improve home quality in its portfolio. Management anticipates being top of mind for sellers, expects increasing market share as product and customer experience improve, and emphasizes flexibility in closing timelines. To achieve these goals, the company will invest in pricing capabilities and risk management framework, leveraging unique data and machine learning algorithms to gain a competitive advantage. The strategy also involves expanding nationwide coverage through the Buy Box initiative, increasing market share in core markets through partnerships and marketing campaigns, and refining the best-in-class seller experience. Management expects to expand its customer base as more consumers start their home journey with OpenDoor, focusing on converting homeowners who are also buyers into customers. While acknowledging potential risks and uncertainties, management remains committed to its strategy, prioritizing investment in pricing capabilities and forecasting systems, managing inventory position, and balancing growth, margin, and risk. The company aims to increase value to homeowners through new services such as insurance and warranty offerings, expand financing sources, and potentially diversify the mix of financing to include more cost-effective options. Overall, management's view on the company outlook or strategy is centered around achieving future financial and business goals through digital transformation, market expansion, and operational efficiency. OpenDoor Technologies Inc.'s acquisitions and divestitures overview. The company's acquisitions have been a significant aspect of its growth strategy. In December 2020, OpenDoor was formed through a business combination with Social Capital Hedosopia Holdings Corp. (IISCH). This marked the beginning of the company's expansion into the real estate market. OpenDoor has also acquired homes directly from sellers and existing homes through its Cash Plus offer program, which involves reselling properties after repairs and listing. In addition to these direct acquisitions, the company has formed partnerships with home builders, agents, and online real estate platforms to expand its reach. However, due to the COVID-19 pandemic, OpenDoor temporarily suspended its home acquisition activities. On the other hand, the company's divestitures have been driven by regulatory restrictions and financial considerations. In 2020, OpenDoor was forced to divest single-family real estate holdings due to regulatory requirements. The company also sold down most of its home inventory during the pandemic, which resulted in a significant reduction in carrying value. Furthermore, OpenDoor extinguished $933 million worth of debt related to its 2030 notes, resulting in a loss on debt extinguishment. Additionally, the company raised approximately $41 million through private investment in public equity PIPE offerings. These divestitures and financial transactions have had a significant impact on the company's financials and operations. In recent years, the company has taken steps to reward its shareholders. While it has not paid traditional dividends in the foreseeable future, it has found alternative ways to return value to its investors. One such method is through the issuance of warrants as a special dividend. This approach allows existing shareholders to receive additional shares or equity in the company. Furthermore, the company has also utilized warrant exercises and warrant dividends to repurchase shares from its shareholders. These actions demonstrate the company's commitment to returning value to its owners while maintaining flexibility in its capital structure. Concerns about inventory buildup and supply chain disruption are evident in the extracted summaries. Inventory levels have been fluctuating, with a significant increase from 5,326 homes to 8,241 homes, followed by a decrease of 58% to 5,326 homes. This volatility raises concerns about inventory valuation adjustments and holding costs. Supply chain disruptions are also a concern, with mentions of labor or materials shortages, catastrophic events such as natural disasters and pandemics, and climate change. These disruptions can impact the company's ability to acquire and hold inventory, leading to increased working capital requirements. The company's reliance on inventory acquisition financing on reasonable terms is subject to factors beyond its control, further exacerbating concerns about both inventory buildup and supply chain disruptions. The potential for inventory valuation adjustments and changes in pricing assumptions also suggests that these issues are interconnected and require careful management. That concludes the financial summary for OpenDoor Technologies Inc. Feel free to comment below, and I will be happy to answer them when possible.